Hi, everybody, and welcome back to video number 2 in chapter 6. And when we left off, we were looking here at some definitional type items. Cash. What is cash? Cash is currency, coins, deposits in the bank account, but they also can include cashier's checks, money orders, customer checks. Often not understood well by new students, these customer checks here are considered cash. And then we have cash equivalents, and those are short term, highly liquid investments. Normally, if I happen to have some extra cash at the end of the month, I'll invest it, usually for a month. Although the definition of cash equivalents in the book is 3 months. And those 3 months, we can convert that to cash relatively quickly. And it's so close to the maturity date, it's not really sensitive to interest rate changes and those kinds of things. So the goal of cash management then is to plan our cash receipts to meet the cash payments when they are due. Sounds very easy, not easy in the real world. We also want to keep a minimum amount of cash necessary to operate, and in some cases, a little safety. Things don't work perfectly oftentimes, and we need a little bit of wiggle room, if you want to call it. So we want to encourage our customers to pay us quickly. To the degree we can, we want to delay our payment of liabilities and only spend money on the assets we absolutely need. We're going to plan our expenditures and invest, as I previously mentioned, our excess cash. All right, internal control to cash payments and receipts. Here is a nice little graphic showing the over-the-counter cash receipts. And none of the people involved can make a mistake or divert that cash without the difference being revealed. So we have the sales department and we have a cashier's department. We have our register sheet, our cash sheets. The cashier prepares the cash records, deposit slips, and journal entry. Supervisor checks that to make sure that everything is running beautifully, and then our accounting people ring up those cash sales on a register and prepare the cash count sheet, etc. So it's a nice system that they show here. Cash over and short. Every now and then there's errors, and normally they're cash short, but sometimes the errors in making change out of a cash register are discovered from the differences between the cash in the cash register and the record of how much should be in the cash register as cash receipts. So in this example, the cash register's record shows 550, but the count of cash is 555. So we have $5 more than we thought we would. So we're going to credit sales for the normal $550 here, but we're going to put that difference of $5 between 555 and 550 here. We're going to put that as a credit to our cash over, in this case, and short account. It's going to be a debit if there's a shortage. As you see here, we're going to debit the cash over and short account if it's less than what the records say it should be. Okay, cash receipts by mail. We always want to have a couple of people assigned to the task of opening mail, if in fact that mail contains customer checks to us. Now, as a practical measure, we have in a big company, we have what's known as a lockbox, where the customer will mail the check directly to the bank. And we get around the task of opening the mail that way. It's a great system. But this PowerPoint shows the checks being mailed to the company instead of to the bank. So in that case, we have two people assigned to the task of opening the mail. The cashier is going to then deposit that quickly into the bank, as shown here. And then the record keeper in accounting records the amounts received in the accounting record. So we have a segregation of duties, as you can see here. So how do we control these cash payments? These cash payments are important, as most of the large thefts from companies involve the payment of fictitious invoices. So how do we control that? We require that all payments be made by check. And we limit access to accounting records except for those who have authority to sign those checks, which is a very small group of people. And then we have a budget too, where we're projecting cash receipts and cash payments, and we compare actual versus budget to see where there might be variances from that. A voucher system establishes procedures for approving, verifying, recording liabilities for eventual cash payments. And that involves several things before the check is actually generated. This is a good graphic here from that standpoint. Let's say I'm going to buy myself a computer for myself, right? What do? Well, I first sit down and I create myself a purchase requisition. I fill out all the things I want on that purchase requisition. I want a couple of monitors. I want them to be really high resolution. I want my keyboard to be mechanical switch. I want USB, several USB ports, etc., etc., etc. And I put that all on my purchase rec. And even though I have a $250,000 purchase authority, because it's for me, I have to get my boss to sign off on that purchase rec, which let's say he does. I trot that down to purchasing, who creates the purchase order. That's the legal document that's going to go to the supplier of that computer. Let's say it's Best Buy. And so purchasing sends that purchase order to Best Buy. Best Buy drives its little truck over, drops off my new system in the receiving dock. The receiving dock creates a receiving report. You can see that here. And Best Buy creates an invoice. Okay? And so what happens is all of that, the purchase order, the receiving report, and the invoice all go to accounts payable. And they assemble that and they make sure that they're all in agreement. They vouch for it, basically. And then that gets translated into a check. And that check is then signed by someone with approval authority in accounting, usually the controller, to pay for that. So you can see the segregation of duties is significant here. We have purchasing, we have accounting, we have several people within accounting. We have the receiving group, we have the Best Buy with their invoice, et cetera, et cetera, et cetera. Pretty hard to fool that system for that payment. And that's the voucher system for a good system of control. Okay, then we're going to explain and look at petty cash. Petty cash is pretty easy. We keep a little box of money handy, and somebody's the petty cash custodian. And normally that I assign that to a relatively senior person in the accounting organization. And once upon a time, my plant manager in in Pennsylvania hired a new secretary, and his long-standing secretary retired. And this new secretary came in with $1,000 petty cash fund, which he assigned to her. That person lasted exactly one day before she abruptly left, taking the petty cash fund with her. Always will remember that. So, nevertheless, it's for small things, minor repairs, low cost supplies, little things. It has the opportunity to be misused. So, to establish that petty cash fund, what we do is we take it out of our regular cash fund with a credit here, and we put it into a separate cash account called petty cash. And petty cash, that establishes that petty cash fund of $75 here. Now, then we have some petty cash receipts that have been approved by the petty cash custodian. And so all of these things then get charged to various expense general ledger accounts, totaling $71.30. And so what we do then is we replenish the petty cash fund like this. We debit all these expenses that we just identified here, and we take that cash out of our regular checking account, not the petty cash fund. So this is going to be a credit to cash, not a credit to petty cash. Okay, and in this case, if we were to audit petty cash before we make this journal entry, we would see we had $3.70 remaining in that fund. So then if I decrease or increase that petty cash fund, yes, I do hit the petty cash fund. But otherwise, that's about the only time either establishing it, de-establishing it, or increasing it, or decreasing it. That's the only time we really debit or credit the petty cash fund. So here we've increased it from $75 to $100, and then here we decreased it from $75 to $55. And I think those journal entries are pretty obvious. So again, we have cash over and short account. If the petty cashier, I call it petty cash custodian, fails to obtain a receipt for payment or overpays an amount, cash over or short is going to result. So there's quite a little bit of good record keeping required for this. So the petty cash payments report the cash left in the account and will not total. We have a shortage. I usually audit this at least quarterly and sometimes monthly, depending on the activity. So I'll go in and check to make sure that we have what we say we would, and if we don't, if we either have receipts or we have cash that total the total in the petty cash fund. And if we're short or over, we debit or credit the cash over or short account. Okay, basic bank services. We have a lot of basic bank services. The bank only knows who's authorized by signature cards. We have several bank accounts in a big company. We have checks, we have funds transfers, we have deposit tickets, and we have bank statements. All of those are used extensively within a company. Okay, this looks like a good place for us to stop this video, and when we come back, we'll take a look at the deposit ticket. Until then, bye for now.